Hello everyone, welcome to the Financial Information channel. In this video I'm going to give you the information on why the stock price might go down even if the company reports great earnings. Now let's begin with the video. And one of the phrases that is mentioned in the stock market is that you buy on the rumors of a company and that you sell on the news. And you have to keep in mind that the stock price will move most of the time based on expectations. And with that in mind, we're gonna start the first scenario why the stock price might go down, and that is cyclical products and services. And cyclical products and services means that some companies do actually produce better revenue and growth during certain parts of the year. And we're going to take Micron Technologies for example. Micron Technologies has a lot of demands on some years, and in other years the demand is not so hot. So a lot of analysts and investors do predict the product demand to go down, and that is one of the reasons why the stock price moves down. Once an analyst and investors think that the demand might go down, they start to sell some position or all the position on that specific company. And cyclical is not just on products, it can work on services as well. For example, you can expect the revenue of restaurants to go up during the summer and at the end of the year. And that is the first scenario why the stock price might move down. Now let's go to the next scenario. And in this scenario, the stock price might move down based on the history that the company has produced on previous quarters. So basically it's not meeting the analyst expectations. And one example that I'm gonna mention is Domino's Pizza. The last quarter that the company reported was actually a good quarter. However, the company has produced really great earnings during the previous quarters, and in the latest quarter it didn't meet the analyst expectations. And when that happens, the stock price actually takes a huge loss. The theory is that analysts and investors are disappointed in the results, and in that case it tends to create a sell-off, and sometimes that creates an opportunity to start a position on that company. You just have to make sure that that company is one of the companies that you have done a lot of research. And the next scenario is simple, and it's taking profits. And that happens even if the company reports good earnings and good guidance, the company will tend to sell off. And the logic is simple. A lot of veterans investors take profit into strength. And the reason behind it is that usually when the company moves quite a bit during the earnings, it tends to sell off quite a bit. And one of the latest examples that happened a few weeks ago was Netflix. And if you remember, Netflix actually moved up quite a bit during the earnings. However, during the next few days, the company started to move down quite a bit. Wouldn't you like to take some profits once you see the stock move up quite a bit and then buy the number of shares that you sold at a lower price? And that idea has been around the stock market for a while. Sell high and buy low. And in the next scenario, the stock price might move down based on guidance. Now, what is guidance? The guidance is the ability for the company to predict the future earnings, and that is very important for growth companies because the growth depends on the future earnings. If a company reports really great earnings but the guidance is really weak, the share price is gonna move down. And one of the recent examples is Kroger. Kroger actually had decent earnings, but it didn't provide any guidance, and investors don't like the fact that they don't know what is going to happen with the company in the next few quarters. Would you invest in a company if you didn't know what is going to happen in the next few years? In my case, I probably wouldn't. And in the next scenario, the stock price might move down even if they report really great earnings based on the sector sentiment. And we know throughout the year, the money invested starts to move into different sectors. So basically, if the company reports really great earnings but the sector is selling off, the company share price might go down. And that theory might not happen 100% of the time, but it happens most of the time. So you have to be aware where the money is being invested in the stock market. And those are just 5 scenarios where the stock price might go down after the earnings. There are many more. And that is gonna be everything for the video. Please leave in the comment sections below any questions that you might have for the second channel Q&A. In the meantime, you can subscribe to the Financial Information channel. I'm gonna continue bringing videos about the stock market, personal finance, and how to make money online. I wanna thank you once again for watching the video. Have an excellent day and take care, my friends.